Welcome back to Middle Market Smart, where we break down what's really driving growth in the middle market. I'm Patrick Goulet, and today we're diving into M&A, mergers and acquisitions. What's driving activity right now, and what actually makes deals successful beyond the numbers. We talk culture, we talk integration, we talk the differences between strategic buyers and PE firms, and what happens in terms of the preparation, the before, the after, the whole lot. We've actually split this recording into two parts, and today we're going to be talking about part one, which is more of the pre and the transition aspect of the acquisition. Bill, I'll pass it over to you to dive into today's subject matter a little bit deeper and to introduce our two guests.
Thank you, Patrick. I am so excited. We have two executives with us who've been on part of many, many deals, both at the deals. And I think the listener's going to be left with, they're going to be armed, whether they're receiving a deal for the first time or they're experienced in doing that, qualifying buyers, the distinctions between working with private equity companies or strategic buyer. So I am really excited to introduce both of these gentlemen. Mark Ianni is focused very much on growth, EBITDA, profitability, exit strategy, and M&A. He's been CEO for PE-held property management construction company, CEO for another PE held managed services and BPO company. He was president of NextEra Energy and spent a decade at GE Capital in leadership roles. Mark Beliczky was a senior operating executive with PepsiCo, Yum Brands, UBS, Citicorp, before spending time as an executive with Carlyle Group, where he led the firm's national practice in asset development and operational excellence. He was CEO of ProHome, and he's led many company turnarounds of all sizes and scaled a number of mid-market companies to national prominence. We are loaded for bear today, guys. Thank you so much for being here, and it's great to have you. As we know, the headlines, the business news focuses on the multi-billion-dollar transactions, the big proxy fights, et cetera. But the real activity, the most activity flow is in the middle market. What's been driving middle market activity over the last couple of years and now?
Great. Yeah, I think there's been a big shift in the number of deals over the last few years. And also, it's more than just deals. There's been a fundamental shift in how companies are adapting to this marketplace. So it's easy to think about this as cyclical, but what we've seen is really a structural change in the marketplace. So M&A has become part of how companies evolve and not just transact. And what we're finding is that industries are more interconnected, they're more tech driven, they're more competitive. And research by Bain and McKinsey show that there's scale and capability. And what we're seeing is because of that, we're seeing performance advantage happening in marketplaces. And companies are able to invest in systems and talent and infrastructure, and they're able to really outperform most other people. So what we're seeing is that we're seeing a consolidation and we're seeing things move forward at a very fast pace. Um, Across the industry, it's playing out broadly into different marketplaces, healthcare and manufacturing and business services. It's just not in, one or two categories. And it's not just growth that companies are moving forward in this direction. This is really about staying relevant. Companies, to stay relevant, are having to have to, acquire or merge with other organizations. So we're seeing this expectation rising across marketplaces. And at the same time, we're seeing capital accelerating in this space. And this is the kind of growth that we're seeing overall in the marketplace. And we're seeing private equity movement. So it's platform plus this, what we call programmatic strategy that's developing over time. So if you look at, say, 2016 through 2014, which is the most current data, private equity assets under management has more than doubled, $7 to $8 trillion. And what's more interesting is that the undeployed capital, what we call dry powder, is at record levels, $3 trillion. And annual deal activity has peaked at about $1 trillion. So it's demonstrating both a massive accumulation of capital and an active deployment, and particularly in middle market growth areas. So we're seeing this shift in strategy. It's not standalone deals. We're seeing what we call platform deals. They're scaling and moving and building more organizations into their enterprises. And this is what we call as a continuous deal flow in this area. And again, McKinsey has done a lot of research in this space, calls it the programmatic acquirer, that outperform people over time. So the structural shift is we're seeing companies built to do deals now, not just more deals. They're doing more organizational designs to acquire these sort of things. So we see M&A becoming what we call structural repeatable capability in these sort of areas. And also within this segment, we're seeing a generational ownership transition. A large number of founder-owned businesses are now selling. And, they're reaching these transition points. This is the largest point probably in the history of our country. And this ownership is happening at this particular time. So we have a fundamental census opportunity and we have industry data. So not just exiting, but these businesses are positioning themselves for their next phase of growth. We're seeing transactions which are bridging between businesses and what needs to become, their growth moving forward. And the pace of change is really accelerating. Again, in the tech sector, being driven by tech sector, consumer expectations and competitions. And, organic growth often happens too, but frankly, it's too slow. So that's why you're seeing a lot of M&A in this period of time. It's faster path to capability building, and it's built over years when you do organic versus months when you do acquisition at this time. So the difference is level and its intentionality. And you have strong performers that are deliberate, they're repeatable, and they're integrating the strategy into their business. So what's really changing? There are four forces that are changing in this marketplace. You have consolidation, you have private equity capital, you have this generational transition that's happening. And from a market perspective, you have a need for speed. Truly, things are happening much faster. So M&A is no longer occasional. It's becoming a core strategic tool in the marketplace. And it's not just deals, it's a different role for M&A. So organizations that are building around capability to execute consistently are the ones that are creating the most value. So three key takeaways, I would say. This isn't cyclical, it's structural, it will remain in place. M&A is becoming a capability, not just an event, and deals are increasingly, driving toward a bridge for a business that will become a true business need. So it's a compelling time with compelling growth opportunities.
The addressable market in the US, given the last census data that I've been able to look at, there's 16 million businesses in the US, incorporated and non-incorporated. 16 million. 14 million are made up of those businesses that you drive by every day, whether it's a restaurant or a professional organization offering accounting services. Usually these businesses are below $1 million in revenue. So that's 14 million out of 16 million businesses in the US. And then you've got the sweet spot when it comes to private equity and strategic buyers. There's about 200,000 businesses in the US that are between 10 and $100 million in revenue. And that is a tremendous sweet spot for a private equity organization, as well as a strategic buyer that wants to grow inorganically their business through a merger or an acquisition or what have you. And then there's about 30,000 companies that are between 100 million and a billion in revenue. And that's also a very important sweet spot for the bigger PE firms and strategic buyers. And that's where the activity, it happens. We all hear about, Netflix and Paramount. These are the other 6,000 companies in the US that are publicly traded or very large and have balance sheets that are the size of most countries. So the reason there's a surge, or the reason there's a lot of activity within, you know, the US, specifically the last few years, is that the addressable market is only a couple 100,000, 250,000 companies. And that's where the activity is happening. And, uh, and I think that's the reason why things are going to continue. Now there's a whole debt versus equity, opportunity with these companies also. But I think, if you're a generational founder, there's no better time than now to look at potentially selling your business.
So, Mark, for many founders and CEOs, the first acquisition conversation begins typically with an unexpected call. A buyer comes in and is looking to have that initial conversation. When an owner is approached about a potential transaction, what are the most important questions they should ask beyond valuation? Because valuation
Yeah,
is typically the first thing they think of.
sure. It's a great question. When an owner is approached about selling their business, valuation is almost always where the conversation begins. It's the most visible part of their discussion. In many ways, it feels like it's concrete. But what really happens in practice, especially in the middle market, that the owner is not simply making a financial decision. They're stepping into a process, that requires their time and their attention and ultimately a transition in how they lead their business. So what they're really evaluating goes far beyond price or the valuation. And one of the first things they consider is alignment around the future of a company. And you look at the research by McKinsey or Harvard, and it shows that transactions, tend to be more successful when there's a shared understanding of what the business is meant to become. So it's important to understand how the buyer views the business and how they plan to grow it and what changes they expect to make over time. So when a seller is looking at this, and if the seller, and we're assuming the seller stays on, which is often the case, the alignment becomes the part of their day-to-day reality. It's not just a strategic concept. No, it affects the priorities, the decisions, and how businesses operate after the transaction. So there's also a question of how the owner's role will change in these situations. Many founders and owners are used to operating their business with a high degree of autonomy. It's been their business, it's been their baby. After a transaction, that really shifts. And there may be a board or a new reporting expectations or maybe different decision making processes. And, that changes can be significant and more than expected. So it's important to understand how governance, will work and what level of influence that seller will retain in that transaction. But beyond the strategic considerations, there's also, the practical reality of what it takes to go through a transaction. Selling a business is not a passive process. It requires a significant amount of time and effort from the owner and their leadership team. You know, there's a substantial amount of information that needs to be prepared and shared, financial performance and operational metrics and customer relationship information and contracts and organizational structure. Buyers are not just evaluating what the business has done, but how it functions in detail. And that creates a second layer of responsibility for those sellers. The owner is still expected to run the business, maintain performance, lead the organization, while at the same time responding to diligence requests and participating in meetings and working through transaction processes. This is a dual role that's really, really demanding. And it's sometimes, most owners or sellers, they underestimate this at the outset. So research by PwC or KPMG highlights that the quality of information, the level of preparation during diligence can influence both deals. Achieving the level of preparation requires time, focus, and coordinations. It's extensive. There's also the question of stakeholder communication. All these stakeholders are part of the business. The transaction affects more than just the owner. It affects employees and customers and partners, and in some cases, lenders and suppliers. And how that communication is handled can have a direct impact on the business and the performance during this process. So again, research by Deloitte and Gallup show that during these periods of uncertainty, during this time, clarity of leadership plays a significant role in, maintaining an engagement throughout this process. So owners need to think carefully about when and how information is shared and how they keep the organization focused during this transaction period, which is underway. And then, there's what happens when the deal closes. So that's just pre-deal, then the deal closes. And studies by KPMG and PwC consistently show that integration of the business is where real value is realized or it's lost. So the seller needs to understand that it's not just the transaction itself, but it will be expected to move afterwards with regard to how they integrate the business. What role will they play in integration? What are the expectations around performance? What will success be measured by? I suspect that most sellers aren't even thinking about all these questions because, in many cases, the seller is not just exiting, they're also part of the execution. So when you step back, the decision to sell is not just about agreeing to a price. It's about understanding the full scope of what this transaction involves before, during, and after the close. So it's really about alignment on the future. It's clarity about how the business will lead, the ability to manage demanding processes through this whole process. And it has an impact on all people and all relationships. So in many cases, those factors end up shaping the experience and the outcome just as much as the valuation itself. It's an extensive, detailed process that most people underestimate unless they've been through it.
Mark Ianni, you've been CEO um, for a number of PE-backed companies, as we talked about in the opening. Describe a deal. I'm guessing no two deals are the same, and there's something to be learned. Talk about a deal you were directly involved in where you learned something important about M&A.
Yeah. I've been involved in the last 20 years with two situations where I was the seller as the leader of the company, and then two other situations where I was involved in the acquiring of a company, the buyer, in other words. And the interesting, some takeaways for me. Uh, I'll start on the seller side. Um, if you're a seller and you're running a business, you have some you have a long stretch ahead of you, which involves a lot of data collection, um, involves decisions being made around, do you want the potential buyer to speak to your employees? Do you want the potential buyer to speak to your customers? You're basically, even though you have an NDA in place and confidential information should remain there, there is a distraction involved as you're running a business and have to also sell a business. A buyer will come in and throw a multiple of EBITDA and it's going to be very attractive. But the most difficult thing going forward is you got to park that number and you got to think about what does this mean for my business? And you know what? I will tell you this, I will tell you that a lot of people in my leadership team, when I went through the selling process, were very emotionally involved because they had been there. For some of them, they had been there 10 years, 15 years. The business was bootstrapped and they went from 0 to 100 million in revenue. And they were very emotionally tied to this business. When we talk about deals, everybody talks about the balance sheet, the P&L and L and all that good stuff and all the the black and white stuff. But there a human element to getting involved when you sell a business, and that's something that all owners, whether you're selling to a PE firm, a financial buyer, or a strategic buyer, you have to understand the process needs to be, you have to be super prepared to move through the process. And you have to understand that this is going to be a big part of you running the business at the same time. On the buying side, the most important thing is for a buyer was due diligence, right? Let's make sure we uncover anything that we should totally understand. In my last deal, to share an experience, the seller did not want us to speak to customers or employees. He was running the sale basically with his lawyer and on his own, and did not want anybody in the organization to find out about this because the concern, and I totally understand it as a seller, is if the deal does not go through and you've already told your employees that this was going to happen, it is an issue post deal death that these employees were going to be sold and they weren't. The companies they'd be sold and it wasn't. Um, so the biggest issue I had with my last acquisition was the owner did not want us to speak to customers or employees, and we agreed to that. Fundamentally, it was a big mistake.
Hmm.
Uh, we got to learn that the employees were not at the level that we thought they were. and we had turnover for the first year of the business. There is a fact out there that nobody really documents, but a PE firm will tell you that if there's leadership transition in a deal, chances are the business will suffer some performance degradation after the deal. 30% of their businesses, have shown if there's a leadership transition to have performed less better than they were pre-acquisition. So that's a good point too. And like I said, I've been on both sides. It's super difficult for a seller to run a business and to be part of a process, but if you're prepared and you have the right team with you, that's an advantage. And as a buyer, you just gotta do your due diligence. Otherwise, these deals are going to be a challenge.
I have to follow up quickly. So is that in your mind, if you're the buyer and you want to speak to customers, is that a deal breaker if the principal says you can't do it?
I'm less concerned with the customer side of things because you see you could pinpoint from order placement to delivery, and you could see who the top 10 customers are, and you could understand how you're important to them. But the employee side of things,
Mm.
I think going forward will be a deal breaker for me. And
Interesting.
it's something that I would address right off the bat with the owner, that if we proceed down this path, I need to speak to your key employees.
Wow. It's you guys have set up, it's a tough process. The negotiations can drag on. Do deals ever turn out better than you expected?
Well, that's a good question, Bill. And deals, I've been fortunate enough to have been part of, companies where um, I think on the buy side, we ended up doing quite well with the businesses that I've been involved with. On the sell side, you know, eh, I know with the leadership transition that occurred after, I left the business, that they tried to, address change management and further revenue growth, and all of a sudden they're reporting to a private equity organization, which is, you know, quite a change because you've got a new boss, especially if you are autonomous, like Mark said earlier. If you're an autonomous owner and you sell your company and you move away, you're gone. You take your money to the bank and you're gone. And there's a leadership transition, and it happens to be with a private equity firm. That organization is going to run completely differently. There are demands on PE firms to return the investment to their shareholders, and that means that you as a post-acquiring leadership team needs to deliver return on their investment. Um, and so on the sell side, I will say that there have been challenges. I wouldn't say there have been failures from the companies that I was involved with. They are still operating and they're doing quite well. One company, actually, the private equity firm used the company as a platform, an anchor, and grew and acquired many more businesses. And right now, they're probably 5 times the size they were when I sold the company. Um, so if you're prepared during the process, and the due diligence goes where it goes, and you have good outside support, whether it's legal support, financial support, you know, and everyone's on the same page, culturally speaking and leadership speaking, um, transactions should not fail unless there's an inherent issue with the business that for some reason was not discovered during due diligence.
Now I have to ask, you teed it up, Mark. Tell me about a deal that was either more difficult or fell apart and why.
Yeah, I was involved with a business where I came in. I was hired by the founders who wanted to engage with more professional management, and they had reached a plateau as far as growth, and they were really at an impasse. One of the founders wanted to go do something else, and the other was not interested in running the business full time. They'd done very well for themselves. So I was hired. I was there as the CEO, and I did a lot of work towards improving and optimizing EBITDA, which was my goal, um, with the intention of 18 months or so, start looking for selling opportunities. So, I went out and I got a few PE firms to look at the business. I got ready for the exit. I did everything I could to prepare the data rooms, and all the stuff that we needed to start attracting the right buyers. And it became more and more difficult because there was dissension within the ownership as far as what the right number was, what the right terms and conditions were. And I found myself to be the middleman. As the leader of the business at the time, I was the face with the buyer. I was the face with the founders. Uh, we went out of our way to make sure that no one within the business was aware that this was going on, which was very, very difficult to do, especially with employees. So the process went from, supposed to have taken 3 months. It took like 9 months to achieve. And it was a very, very difficult negotiation, specifically towards the end of the deal, where the buyer presented an earnout scenario to the owners, and the owner says, absolutely not. We never discussed earnout. So it was kind of a surprise part of the deal that should never have happened, which extended the period even longer. But we got it through the finish line, and we got it through the finish line at a significant multiple. The other side is on the buy side. The last transaction I was involved with, again, I partnered with a PE firm to acquire a business, the same business I mentioned earlier with the access to the customers as well as the employees. That became very difficult towards the end because we had established a 90-day close with the owner. This was a husband and wife team that owned this very nice business. And it got to the point where the due diligence process got way too much for the seller. And I remember on a Friday afternoon getting on the phone with the seller, the owner, as the incoming CEO when the transaction was going to get done. And I had to literally walk him off the ledge. He was tired. 7 months into this acquisition, he was tired of dealing with the questions. He was tired of working weekends to appease the PE firm with all the due diligence that we had. He was tired of negotiating a purchase agreement that wasn't getting anywhere. And that became a very difficult, almost, confrontational sort of acquisition. And it never helps when you go through a sell process or an acquisition process where the parties start getting confrontational during the process. It never helps in post-acquisition because it makes the transition even harder. If you think it's hard to buy the company or to sell the company, it's going to be even harder post-transition, post-acquisition to run the business.
Now, one of the most persistent claims in business is that most mergers and acquisitions fail. How do you interpret that statistic from your experience?
Yeah, it's a great question. Oftentimes you hear that 70% of acquisitions fail, and really, that's not the case. It's widely repeated, but and it feels intuitive, frankly. M&A is complex. Mark talked about this. The outcomes for the results are uneven sometimes, and it's easy to point to some failures. And this narrative sticks for a number of different reasons. But, the first issue is that the definition is inconsistent. There are different measures that you have for success. So short-term stock reaction, long-term value creation, deal, thesis is not realized. There are a lot of reasons for what it might be. But, if you look at the research, if you look at what Bain has said or McKinsey or HBR, M&As don't fail broadly, very frankly. The outcome, varies based on the approach. So it's not random, it's kind of performance patterned sort of things. And what we're seeing out there is, again, in the marketplace is you're seeing more and more what we call successful programmatic advantages where you have platforms or PE firms that do this on a regular basis. They have their playbooks and they work and they're very successful. Those that run into challenges are the ones that are one off typically. And you have a series of small deals that are well integrated, and then you have this capability that builds over time. So value compounds through repetition. So those who do it on a regular basis get greater value, and it's highly successful. You know, some companies see some inconsistency, and it's not that it's broken; it's just that they haven't done it a lot. So where do deals actually break down? And I think we've talked a little bit about that. It's typically not in the thesis of the investment. Strategy is often sound. The issues emerge in execution and in integration. That's where deals tend to fail. And frankly, in the first 100 days, most people, they get deal fatigue. Mark talked about this. There's a lot of work. People are struggling. They're trying to run a business. They're building the car while they're rebuilding something else. And it becomes a real challenge. So integration is the key primary driver of performance or underperformance in these situations. And there's a lot of friction points as well. There's unclear decision making that happens. There's leadership misalignment that happens. There's cultural integration challenges that Mark talked about. So these are all key points for execution and important to consider as businesses move forward. So the reality is that many deals don't destroy value, very frankly. They just underdeliver what the actual potential is. They could be potentially delivering more and driving further. And then you have a timing issue. When people look at these sort of things, when they assess it, it's, did they look at short term? Did they look at long term? And these are some of the challenges that are out there as well. So, what do winning organizations do differently? I think it's an important question. They treat M&A as part of their strategy. They invest in integration capabilities. Again, it's all about integration and how you integrate that business. And that they lead execution at the top, where leadership is driving execution. And it's not treated as just a process where they give it to someone and say, here, you manage it. It has to be driven from a leadership point of view. So you have execution and leadership responsibility. So those are all key points that are really important as you move forward. And so some three key points as well. It's not M&A that fails. It's the execution that varies along the path of integration. And M&A is not the event, it's a capability. And that most deals don't fail, very frankly. They just under deliver under potential. So they're sub-optimized for the most part. So the notion that 70% of deals fail is not accurate. It's not borne out by experience, but you have to kind of look at all these variable factors that drive performance and success.
All right, guys, I'm going to ask it as plainly as possible, right? A deal is on the table. The valuation's right. The financial models look good. There's strategic synergies. All of the money things look aligned, but maybe there's issues with culture and people. Can money and a good fair offer overcome the people and culture issues, or it's always a sticking point? Um, Talk to me about what can hang up a deal in terms of
Yeah.
competing.
Bill, as I said earlier, I've been fortunate enough to be both on the buy and the sell side. And in both cases, there were three elements that I always like to bring up, whether I was selling a business, involved in a sale, or buying a business, which are people, process, and technology. And obviously, the people come first for a reason. The process is everything that the business does, the operational, the scale of the operation, the sales team, how they sell the product and how good the product is. So to your point, recurring revenue is what everybody wants. Uh, but if the first P in the people, process, and obviously technology could be anything from, you have spreadsheets that are tracking the business, and we all look for the more advanced technology. And it doesn't have to be Salesforce, but those two elements, the process and the technology, they reflect, to your point earlier, how a company performs financially. But people forget that people make the business run. And I've been part of a sale of a business that the cultures were completely different. I mean, unbelievably different. One business was before COVID was a remote organization. They had hundreds of people working from their home. And the business I was part of, we would go to this 40,000 square foot building every day, and we would have, we would be sitting at tables and conference rooms and doing what we did. And once we sold the company and the new ownership said, get rid of your lease, you're all going to work remotely. That's just one aspect of the culture. But initially, it was a complete another mind blowing change for the people that I worked with.
Mhm.
And did it kill the transaction? Did it kill the post acquisition integration? Not necessarily, but it definitely slowed it down. Definitely slowed it down. So I go back, the reason I say people, process, and technology is because people come first. And when I mentioned earlier that I was not permitted to speak to employees of a business we were trying to acquire, and I said that going forward would be a deal breaker for me because if you don't know who your people are, if you don't know your key employees are, um, and how to make sure that they will remain with the business going forward post acquisition, um, then you're digging your heels in the wrong places.
Mark Beliczky, it seems that the culture fit is always from the seller side. Can the buyer say, no, no, something's missing in terms of culture and talent, and we don't want to go forward?
It's I have not found that to be the case, with on the buyer side, and where I've seen the biggest issues, and Mark's talked about it, it's about the people side, it's the culture of the organization, you know, that owners are concerned about, and it may be a culture mismatch. Ultimately, the buyer is going to drive what happens in an organization, and the ones that do a really good job are sensitive to cultures that might be different. They spend a lot of time up front understanding that, integrating and ensuring there's clear alignment with the goals and the investment thesis. So the people who do this often, the PE firms that do it often that are building platforms, take time to understand the people side of the business and make it a large part of what they do from an integration point of view. If they totally ignore it, it could have a really big problem in driving and getting to the numbers that they want to get to because people just tend to check out. You don't care about me. You're not listening to what I'm doing. I spoke with someone recently, this was last week, about an acquisition in a platform where there was an issue with the acquiring company who had an ethical issue. They lied about a lot of data. They weren't transparent, and it created huge issues within the current organization. So ethics, culture, people part can drive performance. It could really slow things down if not, managed well.
So, what is the decision criteria, guys? I'm a founder of a company. Maybe I don't really have a very good succession plan. I might like an exit or a sale. What are the concrete things I need to think about beyond just it's an attractive offer uh, from a valuation standpoint?
Yeah, it's a really good question, and from my experience and the founders that I've worked with, in my experience, you know, first of all, they do care about price. So, and if they haven't been thinking about it, and it's an offer that just comes in, and they haven't been really planning it, they haven't had a strategy to plan their exit, they really don't have a sense of what their price is. They don't know valuation. So they'll probably be surprised by the number because they haven't thought about it. So they're going to have to go back and talk to an investment bank or bring someone in and say, hey, I need some help right now because I haven't been planning my transition. So you have to scurry around, partner with an investment bank, say, helping with this. They're going to have to invest some money on this, determine whether this is a reasonable offer. I really haven't been thinking about this. The timing may be an issue. You could have a buyer that's pushing to make this happen right away. They're not quite ready for it, so there may be some resistance on their part. And what I've also experienced with company owners is that They're really concerned about their people. What happens to my people? What happens to this business that you're from? Do I need to stay around? Maybe I don't want to stay around. Maybe the PE firm or another firm says, we want you to be here for 2 to 3 years. And they're going to say, no, if I'm going to sell it, I just want to be here for X amount of time and I'll leave. Sometimes the compensation for the deal is tied to the business performance and that owner staying on board for 1 to 2 to 3 years. So, what we do know is that you probably have a retention rate of owners staying on board about 50% of the time. So and then you have that founder mentality and that founder sort of relationship with all their teams. They leave, and then the teams wonder what's happening if that founder is not there because they've built this culture. So there are a lot of questions that happen, and particularly for people who haven't been planning their business succession, they don't have an investment banker. They haven't been talking to their team. It's a big surprise, and it will probably take a lot longer, for them to make the decision. And they'll have probably more questions than they'll have answers.
On the flip side of that, Mark Ianni, what if, okay, it's not an unsolicited offer coming in, but same scenario. I'm a founder. I don't have a good succession plan. I would like a liquidity event. What types of things do you do to help those types of people?
Yeah, that's a very good question, Bill. To Mark's point earlier, um, if there's a family-owned business, let's say, where the owner has been doing this for many years, they're getting to a point where they would rather, as you said, pursue a liquidity event, put some, take their business that they worked very hard to build. I mean, you know, people that are successful in building businesses, whether it's family owned or just not necessarily family owned, just somebody that's been successful in building a business, um, has some very special, unique skills. And when they decide that maybe I sell this business, there's a lot of things they should consider. Mark mentioned it earlier. What does this business look like if I sell it and I leave? Who's gonna lead it? Do I have to go out and get a leader now and bring in somebody that could lead this business while I'm still here and then pursue the sale, which is usually what I would always advise customers to do, is make sure you have leadership in place. It goes back to the whole people, process, and technology question. Make sure you have a leadership team. Every PE firm will tell you this, and I don't necessarily agree it's 100% true, that they don't buy businesses, they buy management teams. Um, the reality is they buy recurring revenue and they hope that they have a good management team to run that recurring revenue. But it's true. So if you're sitting there and you've run this business, you've been an autonomous leader, you've done things your way, you're, you're, you're jury, judge, and executioner, then pursuing a sale, as we said earlier, is going to be a challenge. But arriving at that place, arriving at that point, you have to consider other things too. The number one thing is you have to have a management team in place that you could sell them as well as the business. But then you have to consider tax treatments. You have to consider, what do I do the rest of my life? Whether you're in your 60s or 50s or 70s, doesn't matter. You've been running this business day in, day out. This has been what you've done more than anything else, sometimes even at the expense of your family. And now you're finding yourself with a big check, and what do I do next?
Hmm.
So you have to be prepared emotionally to do this, and forget about preparing your business, but you as an individual that owns a business and is contemplating selling, you have to be prepared to do it.
And another scenario we didn't talk about, we should, is taking, I have to be more aggressive. I have to use some leverage, maybe roll up an industry or at least acquire someone else. And I feel like I'm ready to take some capital from a PE partner. What types of things should I be thinking about there?
Yeah, I believe your question relates to recapitalization of a business, a recap. So if you're an owner, and that's definitely an option. If you're a business owner and you own 100% equity of this business, and you're able to partner with either a strategic buyer or a financial buyer like a PE firm to, as we say, take some chips off the table. So somebody comes in and says, "Hey, we'll give you X dollars for X amount of equity, but you get to keep your equity, and let us come in with the money and to be able to go out and perhaps get better technology for your business, perhaps make another acquisition that can help this business grow further. Let us come in and make this business better, and you keep some equity in this business. So if your equity is worth X dollars today and we make it better and we find operational scale and we find some operational synergies with another business, or we get technology in place that makes your product even better, there's a second liquidity event for you. And not only you're getting your liquidity event today, but you're still part of a business. And we have leverage. We have the ability to use leverage to make your business better going forward. And you're still an owner in this business. You might not be leading it anymore. You might not be managing it anymore because we're going to have to find people to do it. Um, if unless you want to do it, obviously some owners might want to stay for the ride, but that transition is a bit difficult too sometimes. But yeah, recapitalization is a good way to go. It's not going all the way, but it's going to a place where you could have two liquidity events.
Mark Beliczky, you're nodding. I'm guessing you've made that pitch a few times.
Yeah, well, exactly. And here's the other thing that you see in the marketplace, which is that oftentimes the business leader has been undercapitalized, right? They haven't had the funds to be able to grow like they should. They've been held back, and they have really great ideas, or they may not have enough experience in other areas. So if they partner with someone, they can say, wow, there's some amazing synergies. You have all these systems, you use AI, you've done these sort of things. You can bring these economies of scale that you have with your other business and apply them to my business to drive efficiency, free me up to do the sort of things I could do to grow this business in a path and in a trajectory that I couldn't do possibly. And I'm willing to exchange some of my autonomy for partnering with someone that can help this grow much better and I can have a greater impact on the marketplace. So I think there's some real upsides to partnering.
What are the tough questions they should ask a potential PE partner?
Well, I think it's going to be governance. It's like if they don't have a board, they may have a board of advisors, like who's going to be on the board? What role will I play? What decision making? Obviously, authority and decision making is a challenge. What what kind of reporting will I need to do? And I think that becomes a challenge. There are PE firms that are really hands off when they invest. They don't spend a lot of time. There are some PE firms that are talking to you every other day, every week. So they need to be asking, what will it feel like? Who will I be working with? Can I meet with your team? Can you tell me what your culture is? What are your expectations when you grow and when you invest? Where do you expect this business to be in the next 1 to 2 years, and what role do you expect me to play in your organization?
I would say that, qualifying the buyer is probably already qualified the seller because they're attracted to the business one way or another. But if you're an owner and a PE firm approaches you, you have to qualify if that buyer is real. You have to understand how many deals have they done? Why are they interested in my business? What's their thesis to acquiring this business? Um, what are they going to look like? Are they going to want to have a leadership transition? Am I part of their leadership going forward, or am I interested in doing so? Um, you know, you might want to go as far as understanding how you're going to structure this deal. What's the debt going to look like? How much equity are you going to, have in this business? I mean, all these questions are part of the qualification of a buyer, qualifying that buyer. And you're going to want to ask, what does a due diligence process look like? What's going to be expected of me? What kind of data are you going to look at? How confidential can I how much confidence can I have that this data will be used only for the transaction and then destroyed if nothing happens? I mean, you just got to qualify who the buyer is and what their process is in potentially buying your business. Uh, and it's critical to understand. I talked earlier about interviewing customers and interviewing employees. I would go as far, if I'm an owner wanting to sell my business to a P firm, I would go as far as saying, I want to talk to leaders of your other businesses that you've acquired. I want to talk to the CEOs of the other portfolio companies. I want to know how you guys run the business post acquisition. I want to know how hard it was for them to sell the business to you. I just want to know how you operate as a P firm. And all those questions are legitimate questions to ask to qualify the buyer. You need to qualify the buyer before you engage in any data sharing.
I love that concept. That really puts some power in the hands of the potential seller in a unique way. I think that's really, really useful, guys, and a great place to cap it. You have armed them with good decision criteria, good things to think about. So thank you very, very much. And I'll look forward to part two where we talk about the post deal integration and all the issues to work through there. So thank you very, very much.